Welcome back to Anthony Lee Raw. Guys, we are live. It is Wednesday. It is FOMC day, and most importantly, the ever so overlooked, hokey bull moon day, guys. It is bull moon. What are you going to do about it? I mean, come on. They can come out and hike rates. They can go up by a full percent, and you can't outdo the bull moon. We're going to pump, baby. We're going to pump. We're going to take a look at that, guys. I should have put the poll in chat. There's a poll in chat. I already know what everyone's going to say. I have a feeling anyway, but I should have put the poll in chat about the moon. Let's look at the moon on the chart before we dive in. I don't want to spend too much time on the moon, but there it is. You can see we got the big old bull moon right there, right? The last bear moon was a flop, but we called for this because we looked for this move up. So we did call for this to not work out. We called for this one to work out and this one to work out, but we specifically called for this this last bear moon to not work out, and it did not at all. So we'll see. Let's see who's here first, though, and we're going to dive in, guys. I'm trying to cover some info before the report comes out at 1 o'clock, and then the press conference. The oh-so-important press conference. And this one will be a little extra important because there is no FOMC next month. So this is it until September. All right. Max. What's up, brother? Big Max in the house. Johnny number 5. What's up, crew? West Coast. My bro. Jack. Hawkborn, my workout guy. Hawkborn, I got in a good back workout today. It was pretty good back workout. Actually, it was a subpar back workout. I got to admit, I'm talking trash. It was subpar. I got to step up my game. Invicta, what's up, brother? Glad you're here, man. Glad you're here. Saw you guys chatting it up in Discord this morning. The new Alexander indicator. What a beast when you combine that thing with Damien. I neglect it. I overlook it a lot. I have it on there, but it's kind of in the background. But I overlook it because I don't leverage trade altcoins. But when you combine that with Damien, oh my gosh. I got to looking at that yesterday and I was like, whoa, where has this been hiding? Salt Chain, good morning. All right, guys, let's look over at the FOMC page real quick. Let's go refresh and see what they're saying. 23 minutes till the report. 68% chance they stay flat. 32% chance they raise. I got to be honest, guys. I've been kind of watching some stuff this morning, and you know, some major institutions are saying they're going to raise today, blah, blah, blah. I just think everybody's missing it, and maybe I'm missing it. Like, I'm going to be totally cool coming on here in a month or two if I'm wrong about things and be like, guys, I got it wrong. I'm sorry. I still don't care if I got it wrong. We're close enough to the bottom for me, right? We've already discussed that. But I just think everybody's missing it. I just think, and I can't help but just remember last bear market at this point where everybody was calling for lower. Michael Saylor is selling, blah, 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 blah. fucking blah. Oh, hang on. I got my beeps. Blah, let me do it again. Blah, 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 blah. Blah. I just can't help but remember that stuff. And I remember at the top, 126K, and even the cycle before at 69K, where, you know, you can't stop Bitcoin till 100K and blah, 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 blah. It's those same people, the exact same sentiment right now. And we've looked at the on-chain data. We've looked at all the things. And I just think they're wrong. And all of the folks calling for rate hikes this month or in September or even, I just think everybody's wrong. Like, I know that Kevin Warsh does not decide, right? It's a committee that votes on hikes or cuts or flat. But that's Trump's boy, and Trump wants them cut. And while he can't do it himself, Kevin Warsh cannot cut rates, his job is to get in there and politic, find a way to convince the committee to cut. And he's already said multiple times the way that they're going to do that is they're going to change the definition of inflation, period. And we saw that on the last CPI print, which was the lowest and the lowest in like 6 years and like the biggest cut like maybe ever. I can't remember, but it's not because inflation went down, y'all. It's because they changed the definition. The writing on the wall says rate cuts, not today. I told you not today. I said it'll take one more CPI print like that, and then they'll cut the next time. The writing is on the wall. They're going to cut rates, and it's being priced in for a rate hike. So I just think everybody's missing. This is just the usual jibber jabber you get at the bottom when everybody's fearful. Just like the opposite, the usual, we can't be stopped at the top right before you roll over to a bear market. It's just the usual. Don't buy into it, guys. Don't buy into it. And I told you the other day how you're going to know I'm right. We got these relatively equal lows. Now this one. They're all relatively equal lows. None of these wicks took out the previous. Okay? I think we're going to come get all this stuff. Maybe today, maybe tomorrow, maybe next week. I think we're going to come get it all. And it's going to be that cascading waterfall effect where you just have gunpowder. Bing, 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 bing. You're going to liquidate all those. Everybody is going to freak out right here. And because this is going to look like free fall mode, guys. This is going to look like free fall mode. Everybody's going to freak out. Everybody's going to open up a short about when you get about 60K. Everybody's going to open up a short thing. If sub 50K is incoming, they're going to go, and then these people are going to be trapped. Oh shit, what do we do? Liquidate, short squeeze. And that's it. And look at this nice little head and shoulders pattern, guys. I'm not a pattern bro, but still. You'll start seeing that. Watch, you'll start seeing that. Because that's what happens. When you have these relatively equal lows or relatively equal highs like this, when you break it, you get the waterfall down that people panic on. Panic, 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 panic. You got a mini version of it right here. Waterfall down, boom, big drop. And you're going to get the same thing here. The only problem is, here's the problem. Here's where people are missing it. And maybe I'm missing it. I will gladly come on here and tell you. Do you people know what a poor low or a poor high or a strong low or strong high is? When we came down here, I'm going to zoom in. I should turn all this off. When we came down here at 57K, I'm going to zoom in. We took out the low. So you want to see a liquidity grab twice. I want to see a liquidity grab twice. Set a low here, 59K. You took it out, got everybody all bullish, and then you rolled over and took it again. This is a very strong low. Liquidity's been grabbed, but people look for this liquidity to be grabbed, okay? People look for that. People are ready for that. So when it's grabbed here, they long the hell out of it, building up liquidity here, okay? Right? Swing failure pattern, failed auction, whatever you want to call it, building up liquidity. So when you come back and grab it again, then you wash everybody out. You already got these folks, then these folks got wrecked. The folks that were ready and planned for it got wrecked. You create a strong low and you can pull up and away, and you don't have to come back and get this liquidity. You can, but you don't have to. You've gotten most of it by sweeping this twice. That is called a strong low. And so I just think people aren't seeing it. When these are all well, they're not really lows, but like let's say this was a low and then you came back and didn't quite take it. That is a poor low. That's called a poor low. High probability of getting taken out. Another poor low, right? Series of relatively equal poor lows. You need to come grab those, but you don't need to come get this. That is a strong low. You've already grabbed liquidity from there and there. That's over. But people don't understand that. So when you come grab these, everybody's going to open up a short, and I'm telling you, they're just going to go whoop and yank them up. I'm telling you. Uh-oh, getting a Damien buy signal. Getting a Damien buy signal, guys. Daily Damien buy signal live on stream here. Look at that daily Damien buy. It is unconfirmed. Look, it just disappeared. You're trying to get the daily Damien buy. Oh my gosh, look at this, guys. If you get the daily Damien buy signal, you'll be getting it with, there it is, popping up again. You'll be getting it with volatility tick to the upside and stochastic tick to the upside. It is unconfirmed, and I don't really pay attention to any of this stuff right now until the report comes out in press conference. You know how this goes. But this could be big. See, the last time you got the Damien buy signal here, if you look down below, volatility was headed down, so that was nothing. Little lackluster move. You got it here. Look down below. Volatility was headed down. Little lackluster pump, but you got it here, and volatility was headed up. So let's see what happened. Look at the difference, guys. Look at the difference. Look at the difference. Pay attention. These indicators are freaking awesome. This one and this one, while these were nice moves, I mean, this one right here was, I mean, shit, that's a 21% move. That's a pretty damn good move. And this second one here was 13% move, so pretty good move. Both of them, volatility were headed down. This one right here, volatility was headed up. With stochastic headed up just like this. And let's see the difference. You had a 13 and 21%, and this one was 53%. Big difference. What's the difference, though? Volatility was headed up during that time. That's what I tell you, people. I only take these trades when volatility is headed up. So if we can get this to confirm today, it just fired off. It will close and confirm at the daily close tonight. With volatility headed up, you can expect a big move up on Fetch. I'm glad I bought more Fetch this morning at $13.20. For those of you who don't know, this is the Damien and Bjorn indicators, and you can only get them in the Anthony Lee Raw website. AnthonyLeeRaw.com. Right here. Come on over to, here's AnthonyLeeRaw.com. I say that. There it is. Come on over to the indicators tab. You can get the suite of indicators, all five. Buy five, get three. Buy five for the price of three. Or if you want them individually, there's Damien, the first one, and Bjorn is the second one. You need both. These things are amazing, I'm telling you. And we've been showcasing Alexander today. I put out a video on that today. The Alexander one, these are game changers. I guarantee you I won't use a single other indicator other than these three. Anyway, this is encouraging, guys. I'll tell you what else is good. I'm not saying Fetch is not going lower. I am not saying Fetch isn't going lower, but Fetch took out its low this morning from February. You just went on a liquidity grab this morning. Now you could come lower. I'm not prepared. I'm not prepared to say this on FOMC day, but the job is done. Sure, you could go do more work, but liquidity is the name of the game, and Fetch just grabbed its liquidity. Let's wait and see how today goes, though. Report coming out in 10 minutes, guys. Let's read some chat. Eons, what's up? Hogborn's been subpar all week. I think my body hit its limit a couple weeks ago. The body never hits its limit. The mind hits its limit. The body will push through. Eons, I remember you telling us before how they have actually changed the definition. Do we know yet? Did he say it last time? I don't remember. You have to go deep dive for all that stuff. They just changed which things they use to measure. Like I don't know. Go look at the list. I can't remember. But like, let's say that they come up with the average inflation using housing, oil and gas, groceries, clothes, whatever. They just remove the shit they don't want in the report and put in some stuff that looks good. So they didn't actually go change the Webster's dictionary. They just changed some of the things that are included. They took out the bad stuff, put in some good stuff to make it look better. Ghoul says, I just finished the gym, chest and biceps. This FOMC has become a circus for me. FOMC is nothing. Nothing. I hope you guys caught the video I put out about interest rates. Interest rates don't matter. Interest rates don't matter. Good job, Ghoul, going to the gym, bro. I got to hit it harder. I got to get back to my glory days. You guys know, let me get a little bit of gloating. I'm an old man now, but once upon a time, I was one of Shape Magazine's 50 hottest trainers in America. It's true. I was in the magazine. Actually, I wasn't in the magazine. It was the online section of Shape Magazine. It's true. See if I can find a picture. It's going to be so gay. You're going to make fun of me. Young baby Anthony Lee. I didn't even have a beard. I was so baby faced. Let's see if I can find a picture. From Shape Magazine's 50 hottest trainers in America. Let me see. Here we go. Shape Magazine's 50 hottest trainers in America. I was on second annual. 2013, 2014. It's 2014, 2014, 2014. I don't see the second annual. I only see the 2014s. I'll have to deep dive and find that. I have the picture, though. I don't remember exactly. 2013, 2014, maybe 2015. No later than 2015. It was the second annual one, whatever year that was. I can't remember. It's been over 10 years ago. Here we go. Y'all be prepared to make fun of baby Anthony Lee. Shape Magazine. There I am. There I am. It's true. All right, y'all gonna make fun of me now. Baby face and everything. Oh gosh. That's a good looking guy right there that roped Jane. Jane International. What altcoins are you watching at the moment for trading with Damian Alexander? None. None. I don't, well, that's not true. I just don't flip through altcoins. I have my few, I do analysis and videos on some altcoins by request, but I only watch a few altcoins. I don't do like a lot of people will sit here and they'll go through the list like, you know, I got all these saved, but I could care less about 99% of these altcoins. And they'll go here like this, and they'll look. They'll look for a signal. They'll look for a signal. They're just looking for a signal. And I cannot stress enough how dumb that is, unless you're super experienced. And they'll just look for a signal. Look for a signal. Oh, and then they'll find a signal. They'll find a signal. Like who was on the one earlier today? Brad. Brad's a professional. He knows what he's doing, but Litecoin signal right there. And he'll just find the signal. I'm not saying Brad did this, but they'll find a signal that went off today and they'll just trade it blindly. And I can't tell you how reckless that is. Because you don't know anything about this coin. You don't know how it moves. You don't know support and resistance. You don't know anything. You could sit here and do some research on it, but most people won't. Most people see the signal and fire off a short, right? They'll fire off a short. And I can't tell you how reckless that is, especially on FOMC day, but period. I mean, you don't know if there's any news events coming up about it, if they have anything, you know, that's supposed to happen in the next couple weeks. And for me, this is going to sound gay, but I like to find 2 or 3 coins, and that's it. I track them. This is going to sound gay. I become intimately familiar with these coins. I can tell you exactly where every support and resistance level is on Fetch, every major support and resistance level, every key level. I can tell you the targets. I can tell you how it moves. And that way, when I do enter trades on it, I'm not saying I'm always right, but I have a pretty good understanding of how this coin is going to move. That being said, there's none of my coins right now that I feel like are close to a signal. I mean, we're getting a Damien signal on Fetch right now, but I'm absolutely not interested in taking any trades until probably Friday. Just because FOMC is going to wreck everybody, and that's just the way it is. And sometimes that can take a day or day and a half for that dust to settle. So by Friday, the market will choose a direction, and I'll be ready to trade again. But even then, I'm only going to watch the trades that I follow. Fetch, INJ. Occasionally, I'll branch out and glance at something else if somebody asks me to, but you're going to make more than enough. Like, I don't always have to be in a trade. And at the end of the day, I'm mostly trading Bitcoin. But I will certainly let you know, you're in the VIP, I will certainly let you know when I do take a trade. And once this bottom is solidified, we've talked about this, and I know you're new to the Discord, but we talked about this a lot. I feel like the bottom is in for Bitcoin, right? But I do not feel like the bottom is in for a lot of altcoins. Fetch just proved it. Fetch set a new low today. And we were trading a lot. So let's go to the altcoins. Let's go to Fetch. We were trading a lot. Gosh, dog it. I hate how on TradingView, like if I draw a line, right, and then I finish that line, it goes back to the cursor. But if I draw a pin line like this, it doesn't go back to the cursor. It stays on the pin. So I always write all over my chart. I hate that. I hate that. So when we were in this section right here, kind of like all of this, really all of this. We were trading a lot, doing a lot. I'm on the weekly time frame. Let's go to the daily so you can see better. We were trading a lot. I mean, I was buying, selling, accumulating. But then when we started breaking down, I stopped because you can't trade this. You have to have it. You could far better trade if you're accumulating. You have to have price go up. So you can trade this structure, right? Because you have to buy low, sell high, buy low, sell high. It's hard to do right here when you buy there and it just kind of goes sideways and down, right? So once we kind of bottomish off here and start this uptrend again, I'm going to start trading like crazy in Discord, okay? So for those of you who are wondering why I haven't been sharing that stuff with you, it's because you can't trade this. You could leverage trade that, but you can't spot accumulate a downtrend. You can't do it. Because you have to have price going up. You know, I need to be able to buy $10,000 worth right here, sell it right there for $15,000, then ride 15 back down and rebuy for 50% more, then ride back up and sell this for $30,000, ride back down, buy 50% more, ride back $50,000. You know, I need to be able to do that. You can't do that when you buy 10,000 here and then it rolls over and now you're sitting at 5,000. You can't do it. You have to be in an uptrend. So that's why in the last month or so, I've stopped doing that. But it's going to pick back up. And when it does, it's going to be the big uptrend, and we're going to be having a lot of accumulation. So don't worry, bro. I'm going to bring that back to the Discord. Just in case you guys were wondering why I haven't been doing those trades, you can't do it here. There's really only one trade you could have gotten, and that was right here. That was it. That's it. I mean, if you bought this, you got wrecked. If you bought this, you got wrecked. If you bought this, you got wrecked. And none of this looked good to me. This is the only one I would have considered, but Bjorn was not headed up when we got that. Hope that makes sense. Alan Knower, what's up, brother? Glad to have you here. Very cool, got clout. I wouldn't call it clout. Back in the day, no beard, that's right. Invicta, yeah, I was a trainer for 20 years. I owned 3 gyms. Bro, you can't tell, look at that. I'm just kidding. Yeah, I was a trainer for 20 years. I owned 3 gyms. Hallborn says, I got to do fitness videos. Surprised not doing fitness content. I did fitness content for a long time. And when I got out of the game, I just kind of stopped all that. Ghouls 44, ex-Marine. Now just infantry. Lieutenant Colonel in Greece. Never stopped working out. It's a way of life. Good job, man. Never stop working out. Just don't try to do things you do when you're 20. No. I will never stop working out, Lord willing. Oh, we got to flip over. But, no, I definitely can't do the things I used to do. I don't even try. I used to squat over 400 pounds. I don't even try to put that kind of weight on my back anymore. I don't do any of that stuff. I work hard. I'm not one of those that works smarter, not harder. I still work hard. I just don't do as much dumb shit as I used to do. Rate should be coming out right now. Anybody got it? They held the same. Rates are the same. All right, flat rate as projected. Let's see how the market handles that. Look at this fetch, guys. Look at this fetch. I bought fetch this morning. More fetch. I bought over 200,000 fetch yesterday. I bought about 20,000 more this morning. I'm addicted. I have almost 1 million fetch now. Like 840,000, something like that. Almost 850,000. I only leverage trade Bitcoin, bro. Only leverage trade Bitcoin. I'm not saying leverage trading altcoins it's just not for me. There's some guys that are really good at it. Invicta there, my podna, our redheaded stepchild. I don't know if he's redheaded really. I'm just saying that's an old saying here in America. He's really good at it. I'm not. I just got tired of watching altcoins, and I would get the perfect setup. We're going to long. I mean, it looks beautiful, and then Bitcoin goes down, and my setup is ruined on altcoin. I would get wrecked. So if that's going to happen often enough, then why not just trade Bitcoin? Plus, you will come to realize if you're smart with your money, you can spot trade altcoins and make an enormous amount of money. Think about this, bro. Think about this. I want you to think about this, okay? And I run this scenario through people all the time, but it just doesn't seem to stick with people. And I know I started with a big balance. I mean, maybe my balance was small to some people, but big to others. This is in Discord. You can go look this up, by the way. I don't know where. You just have to go find it somewhere in the altcoin channels. I started out with a $55,000 account. This is in Discord, okay? On February 1st. February 1st, okay? I want you to pay attention. I did spot trading just to buy low, sell high, and I was giving trades in Discord. You know, I just bought $50,000 worth of fetch. I just bought $60,000 worth of WorldCoin, whatever it was, and then I would tell them when I sold. And by, I don't remember, like June 1st, maybe into June. So by end of June, we'll just say by July 1st. I don't remember the exact date. I had grown this to, I think it was $188,000. Okay. So I had almost 4x'd my account. Okay. Almost 4x my account. So I've bought a shit ton more coins. I have 845,000 fetch now. Okay. Fetch coins. I have 800,000 flux coins. And let me see. I have like I want to say I have 10,000 INJ. Just under 10,000. It's like 9,700 and something like that. Anyway. Okay, if I had not done this, if I just took my $55,000, right, divided by, fetch is at 14 cents right now, I could have bought 392,000 fetch. Call it 400,000 fetch, okay? I could have bought 400,000 fetch. Instead, I have over double that amount of fetch plus 800,000, that says 800, that should be 800,000, 800,000 flux plus 10,000 INJ. Okay? Let's just say I had, so I would have had 400, pay attention, I would have had 400,000 fetch. Let's say I just put it all in fetch and I brought it to 188,000 divided by 0.14. I could have bought me about 1.4 million fetch coins. Okay, 1.4 million fetch coins I could have bought. Okay, and let's say fetch goes to $2. Let's just say $2. Went to 350 last time. I don't know where it's going. Let's just say $2. So if I'd have taken that 390,000, which would have been my entry if I hadn't spot traded, I would have made $780,000. Okay, but now if I have 1.4 million times 2, I'm going to make 2.8 million. So I'm going to 4x my money, my profits in the next bull run for not having invested a single nickel more, just doing spot trades. And that's not all, because I'm not done. I plan to grow this. I plan to grow all this. I plan to at least double all this. And I'm not even kidding. I did this last cycle. Spot trading, no leverage whatsoever on altcoins, just leverage on Bitcoin. That's it. This is where the real money is. Let's say you get on a coin that 10x's. I just showed it, but let's say you get on a coin that 10x's, okay? So if you invest some money, you could 10x your money. Well, let's say you're able to 5x your holdings by then. So then you 5x your holdings through spot trading. Next thing you know, you're 50xing your initial investment on a coin that only did a 10x. This is where the money is. But everybody gets wrecked leverage trading before you even get to the spot trading. And once they realize they should have stuck with spot trading, it's too late. The problem is us, the society, the world. I blame social media. Everybody wants instant payout. Fast, 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 fast. And to do this spot trading stuff, you have to wait. It takes years. At least a couple years. Because you got a bear market where you're accumulating, and then when the bull market hits, you ride up for a year. Whereas a leverage trade, you could go in today and make 10 grand on a trade today if you're trading right. Everybody wants fast. Get rich fast, you get wrecked fast. Life-changing money is made spot trading these altcoins. Telling you. I've done it both ways. My first cycle, I got wrecked. I mean, I did well on my Bitcoin holding, but I got wrecked leverage trading alts. I figured shit out and spot traded alts in my second cycle, and I will never go back. So I'm not telling you because I'm a know-it-all. I'm telling you because I've been there, done that, and I learned from the school of hard knocks, bro. I learned the hard way. I'm a hard way learning kind of guy. Let's see. Max says, dude, that combo of Alexander and Damien, WTF, backtested it on 2 alts in Bitcoin. It adds tens of percentage gains on almost every trade. I'm sold. Dude, if you guys don't know what I'm talking about, I put out a video this morning, Alexander altcoin trading strategy. I'm telling you. It works on Bitcoin too, but I'm telling you, this is a game changer. AnthonyLeeRaw.com, indicators tab. There's Alexander. Damien right there. Just get the suite. You'll get all 3 instructional videos. And somebody asked me earlier today on YouTube what the subscription cost is for. There's no subscription. Once you get the indicators, whichever one you get, it's lifetime access. You got it. That's it. No monthly subscription. Here they are, both here on the screen now. Here's the last Damien signal. They got the buy trade, and then Alexander should be used as confirmation. About the time you're wanting to get out of here, Alexander fired off and said, nope, just kidding, stay in the trade. And now you would be out because you've got both signals firing contrarian signals. All right, here's a good example. So here's why you need both, because you get Damien here, which is a good signal, and I use it with Bjorn. It's a good signal, right? It's a great signal. It's great. But this didn't produce much of a move, and then you move back up, right? So, you could have made a little something if you got out there, but you did not get an Alexander sell signal to go with it to signal continuation. Here, you got it, so when you're coming down, you're thinking about getting out because this was such a small trade here. You're thinking, oh, God, we might just do this and move back up. But instead, you got Alexander to go with it. Alexander to go with it, got it. Then you got Alexander a few days later that says stay in the trade. Much bigger trade when you get them combined. Much bigger trade. So, telling you, these things are great. Things are great. And you need both because you don't always get a divergence, a Damien divergence. Here you got a divergence. You came in. You got Alexander said stay in. Boom, you got this. You get out. Well, then here you got another nice move here. Boom, but you did not get a divergence trade here on the daily time frame. You did not get a divergence. So you would have missed this trade if you didn't also have Alexander. Go check them out. Go watch the videos. Brand new video. It's only like 7 minutes long. It literally changes your percentage. Like just right here, the most recent. If you got in here, which we did, given in the Discord, most people probably would have got out on this pullback right here, right? So you may have made about 7-8%, but Alexander fired off, so you could have stayed in it until you got the divergence get out signal, which would have given you a 14% gainer. So instead of 7, you made 14. That's a lot. That's a big difference, guys. I usually trade with a $3,000 account. Everybody knows this, times 30x leverage. So at 7%, if I'd have made that 7%, I made $6,300. Okay? Well, if I would have had Alexander on the chart, I would have made $12,600. So I made another $6,000 by having this signal right here tell me to stay in the trade, continuation. Enter the trade, stay in the trade, get out of the trade. It's all I use. These are all I use. That's it. Enter the trade, stay in the trade, get out of the trade. Yeah, Ghoul, most of the altcoins are trash. Salt Chain straight traded alts this season. I don't leverage trade alts. There's no point, especially if you're using these indicators that I have, there's no point. You can make way more than enough leverage trading Bitcoin, and then use these to spot trade your altcoins. Like here's Fetch. I have both of these on Fetch, daily time frame. You got the Damien signal, okay, boom. You could have got out if you knew to get out there. No Alexander follow through buy signal. You did not get a buy signal, right? So no follow through, right? You get it here. 3 days later, you get Alexander. You get Damien. 3 days later, you get Alexander. That says continuation. Here you get sell signal, Damien. Good little move down. I mean, it's not terrible. What is this? I mean, that's a 15% move down. That's nothing to sneeze at. That is a big-ass altcoin move. But no continuation signal. So you come back up, you get it again, but this time you get continuation signal with Alexander. Boom. So your 15% move, once you got the continuation, turned into a 25% move. And you got the signal to get out right here. Let me clear it up for you guys. Get in, continuation, get out. I mean, you just can't do it any better. Can't do it any better. Get in, that is Damien. I'll toggle it off so you can see it on and off. Get in, and then here's your continuation. Continuation, get out. These are not small moves, guys. That is a 54% move. Last time, AnthonyLeeRaw.com, indicators tab up top. You started with $1,000. You guess you're the poorest here? No, bro, you're not the poorest. You're not the poorest. Dude, I started with $10,000 on my first cycle and made over 100 grand. My second cycle, I started with $25,000 and made $1.2 million. This is documented in Discord. I'm not talking shit. You can go look it up. You just have to just be smart about it. I'm telling you, you do you. You may be a lot better than me at this, but I'm no Invicta. And I can assure you that 9 out of 10 people are going to get freaking wrecked leverage trading altcoins. Stick to Bitcoin, spot trade altcoins, and you will be more profitable than you ever imagined. Now, if you're just that damn good like Invicta, and I tip my hat to him, the guy, that's just his thing. But very few people can do that. You have to be really experienced. And I'm telling you right now, bro, you definitely don't need to do it because you don't even have a paid TradingView. And I'm putting your business out there, but you need to be able to look at the daily and weekly time frame and stuff like that. You cannot do it on the 1 hour and 4 hour time frame. Just kidding, bro. I'm not trying to tell you what to do, man. I'm just kidding. I'm just trying to help you. Really. I like you. We're buddies. I want to see you do well. Eon says, there you go, says Gould, just keep going. Eon started with $200 and just kept grinding. I trade conservative, mostly spot trading now thanks to AL. That's me, AL. And it takes a while to grow, but it does eventually does grow, and it snowballs. 1,000 becomes 2,000, becomes 4,000, becomes 8,000, 16,000, 32,000. It snowballs. So it seems slow now, and I used to teach this. You've got to stop thinking about dollar gains and start thinking about percentage gains. Like a 20% gain right now doesn't seem like much. It's $200. Like, who cares? It's $200. But when you have a $10,000 account, a 20% gain is $2,000. So start paying attention to your percentage gains and not your dollar amount gains, and it'll come quickly. Let's hope for the best with him, the Damian Alexander. Yeah, go get him, bro. I'm telling you, go get him. I'm telling you. See, what people don't understand, like I don't care, like what people do. I created these indicators because they work, and I get tired of people, not people, but I got tired of myself overcomplicating everything with 10, 15 different indicators, and I said, what do I actually look for? What is the theme? What am I looking for? I'm looking for volatility going up. I'm looking for direction, and I'm looking for divergences. That is all I need to successfully trade with a very high probability. And I went and combined a whole bunch of different indicators. I took all the parameters from RSI, MACD, money flow, momentum, and I combined them into one, really two, indicators. So clutter-free on the chart, it gives you everything you need. And if there's conflicting signals, like you might get on one indicator an RSI divergence, but you don't got it on the MACD, and you don't got it over here, and you do got it over here, never mind that nonsense. It lets you know when they all jive together. So the probability is really high. And I'm just telling you, it's all you need. So right about social media, I'll probably split it between $800 spot trading from VIP Discord and the rest, 200 leverage on Bitcoin only. Look, it can be done. We're going to get in some really big spot trades on altcoins, okay? Just pay attention to those when we start. I'm telling you, bro, spot trading altcoins, you see my Bitcoin profits, it's nice, but that is, believe it or not, that is not my forte. My forte is spot trading altcoins. I just haven't been able to do it since you've been in Discord because everything's just going down. And in order to spot trade, you have to have an uptrend or at least enough counter trend rallies. But we've just been kind of in free fall mode. What's the chance of Fetch never recovering? I hope 0% chance. I think on the worst, and I do mean worst, I could be wrong. We got to get this stream going in a second. I think on the worst case, you need to go watch my Fetch videos if you haven't, by the way. Here's my bear case, conservative case, bull case for Fetch. I think worst case scenario, Fetch returns to $1.22. Worst case. My likely sell target is $1.70, at least for half of my bag. I think if you get above $1.70, you're going to $4.35. I don't think you stop anywhere in here. I have a video out on this. I have a video out on this specifically. By the way, if you don't know, you can come over to the YouTube channel and go to the videos and click on this little search feature. And you can type in Fetch. And so you don't have to scroll through all my videos. It pulls up all of my Fetch work. Here we go, right here. This video right here. It says Fetch AI bull run targets bear conservative bull case. If you go watch this video right here, I go over all of my targets and why they're my targets. But I don't think you stop anywhere between $1.70 and $4.35 if you make it over $1.70. Worst case scenario, Fetch goes to $1.22, in my opinion. Passionate Fitness. Bro, what's up with that name? Are you jacked? Just curious. We like jacked fitness people around here. Were you here earlier when I showed my Shape magazine picture? No, I don't do copy trading anymore. I used to. I got everybody wrecked on one trade. We took like 100 trades. I think I won 97 of them, and everybody got wrecked on one trade. Legit. I think we won 96 or 97 out of 100. And then had one really bad one. I mean, I didn't get wrecked. But a lot of people had their entire account on there, and which I've told them, everybody, I always tell everybody, do not put more than you're willing to lose on any one trade. There you go, West Coast. TradingView has seasonal sales for pro versions. Yes. I mean, it's a long way away, but they always have a Black Friday. The Thanksgiving sale always is 80% off everything. And if you go on and go to like you're going to subscribe to one of their paid things, and you fill out all your information, but you don't finish it, you know, you just exit out. You don't complete the sale. You just exit out. Usually within a week, they're going to send you an email that says, oops, you left something in your cart. Come back and get it for 60% off or whatever it is. I got one. Mine expired about 6 weeks ago, and I did that. It didn't expire on purpose. I had it on my card, and my card had expired, so it went to auto-renew, and it didn't. And so I went to renew it, and I was like, oh, shit, they've, like, tripled their rates. So I didn't do it. I sat back, and I was going to go search around for, like, one of those coupon dealios. And, like, 2 days later, I got an email, oops, you forgot something in your card. Come back, 60% off. And I was like, boom, done. Go by the TradingView next month. Yeah, try what I said first. You should do that today, what I said. And I bet you between now and then, you're going to get an email that says, come back and complete your order, 60, 70% off. I bet you anything. Let's see if we can find this stream. I had a wrecked influencer too. I don't think I have time. Oh, by the way, speaking of which, be sure you're here Friday. Look for this thumbnail. The August price prediction stats will be out on Friday. I was going to do them today, but it's FOMC, and what are you going to do? What are you going to do? So you got to wait till after FOMC. But this will be out. And if you've never been here before, I'm not tooting my own horn, I am, but we're really good at these monthly stat predictions. It's based on historical data, the entire life of Bitcoin. Matter of fact, if you don't believe, I'll show you what it looked like for this month. This was our projection for this month. And I would say we pretty much nailed it. The month's not even over. This was our blue line drawn at the beginning of the month, and this was my prediction right here. I mean, we could still push right up into there. We called for a pullback in the first few days. This is an average box, by the way, which means some months price went here and some months price went there, and you get the average in the middle. Called it for a pullback, a pump up. Then we called this on the 8th. We called for a dip, then rip. And this was just based upon historical price action by Bitcoin. All right, guys, I'm going to set my alarm for a few minutes. All right. I don't buy and sell much during the bull run. Once it kicks off into a big bull run, look, once it kicks off, I buy and sell a lot right now. So I don't anticipate us getting out of here quick. This is going to take some time. This is going to be your accumulation zone, okay? I don't do much when we start that. And here's why. You'll get wrecked if you do. You could, like this whole move up, this was a 6,500% move up by Fetch, right? There's really only two trades in here, right here and right here. So I don't buy and sell a whole bunch. If you tried to, sell right there and rebuy here, you got left behind. So you wind up buying them for less. So you have to be very selective. And I have key targets marked out that I'm interested in buying and selling at. And these are available in my VIP Discord. I have gone through, taken into consideration the tokenomics. Like here, you're adding in triple the circulating supply you already have from your all-time high, 750 million coins, and now we have 2.3 billion. So these targets, these are not going to be accurate. You can't find these targets right here. These are not going to be accurate because you've tripled your circulating supply. So you have to find new key targets with the new circulating supply based on market cap. And I've done all that. Matter of fact, I put out videos on all that, but I have them marked out for my VIP Discord. And when we come up and hit a key level only, wherever that is, I'm going to be interested in a trade if we get the Damien, the Bjorn, and the Alexander signals there. I will be interested in a big trade. But these are big-ass trades. Like this trade here, this pullback right here, last cycle, that's a 73% pullback. So I could more than double my holdings just right there. So if this whole thing, I would 10x, let's just say I would 10x right here. If I got this trade in, now just with this one trade, I'm 20xing my gains. So I got to be selective. I can be a little more liberal. Wait, I will never be liberal. Let me change that. I can be more lenient with my trades in here because we're not really taking off. But once we start blast off, I have to be very, very selective. You're welcome, Ghoul. I had a wrecked influencer. We don't have time for it. That's all right. We'll get to that Friday. Guys, just before he starts this, just so you know, interest rates don't matter. If y'all missed the video I put out the other day, interest rates don't matter. I put out a video. I want to show you real quick before we get started. Look at this, guys. Look at this, guys. I'm going to prove it to you real quick. Rate hikes are not bearish and rate cuts are not bullish on the macro. It's not true. It's bullshit. Don't believe anybody telling you that. Yeah, it might affect price that day or the next day or for a week, but it doesn't matter, okay? It does not matter, period. I'm going to show you what matters real quick, but then we got to get on to him talking. Let me move him over here so I can see when he comes on. He's coming out in a second. Look at this, guys. If you missed the video the other day, here are the only times in history in the blue shaded boxes that Bitcoin has ran, that has really ran. And it has only ran up in macro moves when interest rates were sideways. Look right here, guys. Interest rates going up massively. The blue line, massive increase. Look at Bitcoin, massive increase. It doesn't matter. Here, prices going down, rates going up. Here, look at here. Rates going down right here, but Bitcoin price going down. Then when it flattens out, price runs again. It flattens out, price runs again. We need flat rates. We don't need cuts. We don't need hikes. None of that shit matters. Here he is. He's on.
Get coverage you control. The economy is showing impressive.
Workforce, and the unemployment rate has changed little. Inflation remains elevated relative to the committee's 2% goal. The committee remains resolute. You've heard this before, but we will deliver price stability. As before, the policy statement conveys just the facts. It's steering clear of forecasting, a choice we consider especially prudent at these uncertain times. Uncertainty, however, does not mean a lack of clarity. For some households, businesses, and market professionals, 5 years of high inflation have left a mistaken impression that's hard to shake, that the Fed's implicit inflation target was somehow above 2%. Let me reiterate, there is no soft inflation target. There is no soft implicit target, not on this committee's watch. There's only a target, and it's 2%. Not one of my FOMC colleagues is under any illusion. We have begun a new chapter, and we understand that the 5+ years of inflation above target cannot be cured in 9 weeks or by a single month of modest price decreases. This Fed will not waver. Our credibility rests on performing our duties and delivering on our responsibilities. Americans are right to expect that because our nation's prosperity depends on it. To the regulars here in the press room, today's assessment might sound familiar, yet there was nothing inertial about our discussions, our policy, or our strategy. 2 economic developments are worth highlighting. The first is a very notable change since our last meeting 42 days ago. Nominal and real yields are materially higher across the Treasury curve. In fact, some of the increases in market interest rates between FOMC meetings are among the most significant in the last 2 decades, ranking around the top decile or so. But if the committee didn't change its policy rate, what happened? In the intermeeting period, market attention centered on real data and real economic developments. Prices reacted in real time to incoming information, and the reduction in forward guidance may have been a factor. Market participants are learning to play the ball, not the referee, and market prices will continue to respond in the direction and magnitude they see fit. This is, in my view, a change for the better, and we're just getting started. After all, the central bank need not always and everywhere be the center of attention. I understand the desire for rolling forecasts and commentary from this committee, but for our part, we need to observe market reaction to developments, direct and unfiltered. I want to stress, of course, that decisions by this committee matter a great deal. And where necessary and appropriate, we will not hesitate to act. A second economic development is one that I noted at the congressional oversight hearings this month, but it's worth repeating. The most striking feature of the economy is the strong growth of business investment. The surge in high-tech CapEx has been remarkable, but that does not necessarily make the Fed's role any easier. In the AI-related category of high-tech equipment and software, the most recent data shows 4-quarter growth rates of nearly 20%. This is helping to sustain the healthy momentum of manufacturing output. More generally, CapEx is preparing the ground for future growth. Nonetheless, the precise timing and magnitude of effects on the supply side remain hard to predict. FOMC meetings produce policy decisions, but just as important is candid discussion of the big things that matter most. That too is a priority in this new chapter at the Fed. In our meeting, vigorous discussion centered on 4 questions, which I will enumerate. First, we talked a lot about the implications of the past 5 years of high inflation on the current policy conjuncture. To echo an old phrase, has the past really passed? Second, my colleagues and I considered the economic shocks of recent years, strained supply chains arising from the pandemic, military conflicts, energy supply disruptions, substantial increases in tariff rates, and yes, the surge in AI-related investment. These differ in their sources. Do they also differ in their effects on output and employment? Third, we took up the related question of price increases arising from shocks. The business CapEx boom, for example, is driving up prices of memory and logic chips and associated AI infrastructure. Do these changes indicate a broader inflationary dynamic, or do we just focus on them because they are under the bright streetlight? Finally, we discuss monetary policy tools and strategies for achieving stable prices. If, as the Fed has long held, interest rate policy should be its primary monetary policy instrument, how much accommodation are we getting from the balance sheet? In all of this, our work is advancing at the Fed. We're asking the right questions. And in this consequential time, we know how very much depends on getting the right answers. Of course, you've all arrived with questions of your own, so let's turn to them now.
Let's start with Steve.
Thank you for taking our questions, Mr. Chairman. Sure. You've had a couple months now, or 9 weeks, or whatever number it is, to see the markets behave in the absence of forward guidance. I'm wondering if you could tell me, what message are you getting from the markets as to where policy ought to be right now?
Yeah, so I think officially it's 8 weeks and 4 days, but I'm not counting. The message from markets is the message from markets. What I've really been trying to do, Steve, as I think you appreciate, your colleagues appreciate, is getting an unfiltered message from markets, getting a direct message, letting buyers and sellers meet at prices for treasuries, for the foreign exchange value of the dollar, and then trying to judge for ourselves, what does that mean about our remit? How are we doing on inflation? How are we doing on employment? We're trying not to interfere with that market signal. That's part of the reason why we've been somewhat spare in our words, why we pulled back from forward guidance. So they're reacting to events, I would say, much more directly over the 42 days since we last met. This is a good thing. As I mentioned in the prepared remarks, we've seen a material tightening, not just in nominal rates, but in real rates too. And we're observing it. We're trying to stay out of that because, you know, many of you might be interested in our reaction function. We're interested in the reaction of financial markets.
I get that, Mr. Chairman, and I guess the follow-up question is, if the markets are talking to you, what do you hear them saying? And if it's real rates are higher, it would suggest that that's where the funds rate ought to go.
Yeah, so
Sorry.
I'm sorry, it's your question. So interpreting markets is an imperfect business. We central bankers like market pros can think these things are overdetermined, but let me offer some speculation. First, as we said in the FOMC statement that you got at 2 o'clock, the economy output is solid. CapEx and productivity are strong. Labor market's solid, steady. The bond market, the treasury market, it seems to be saying that as well. If I were to try to break down, disaggregate the treasury market signals, I wouldn't be able to do it perfectly. But the bond market's saying many of those same things, and that's why we're seeing a tightening both in nominals and in reals. Even while at some level we haven't done much in 42 days, the markets have done quite a bit.
Claire Jones, Financial Times. You seem to have got the family fight you were after at this meeting. We saw three dissents. Could you characterize the arguments that those dissenters put forward, please, and tell us a little bit why you weren't persuaded by them at this stage? Thank you.
So I guess I shouldn't give you their best arguments. I'll give you some others. So you're right. I asked for a good family fight and I got one. That's the purpose. That's the design feature. I come into this meeting, even this press conference, heartened by what I've experienced the last 2 days. Most of our discussion were on the big questions that matter to the conduct of monetary policy. We didn't sort of hide from them. We weren't scared of them. There was a lot more interaction between and among my colleagues. It was a real family fight. My view, which you've long heard, is that's the better way to get policy right. That's our North Star. So there was a lot of agreement that I heard that we have the powers, the tools, also the authority to deliver stable prices. No walking back from our responsibilities. There was a large majority support for the decision that we made in the room. But I also want to leave you, Claire, with one other impression. There was nothing inertial about that discussion. It was an active, robust discussion about what's in the full range of what we can do and might want to do in the period ahead. You characterized accurately there was a disagreement about a decision today. I would say that doesn't sort of capture the full essence of the discussion. The path to central bank heaven requires delivering on our remit. These days, that means delivering on price stability. I wouldn't measure that path in 42 days or any one particular meeting. And I came out of that meeting even more confident that this is the right team to win the battle against high inflation.
How much do you think not going in July was down to the cool CPI print for June?
So in 2 words, not much, not much. I'd like to believe that the committee shares my views, which is the historic problem with data dependence is the data and the dependence. We are not relying on any one individual piece of data as cover or as an excuse or as validation. What I care about and what I think the committee cares about is trends on the data. Sure, we got some encouraging inflation data. I think at the meeting 42 days ago, I said something like 63 months of inflation above target. I didn't say 64, though the final calculation might be a close one. So we'll be watching inflation data over the period ahead, but I also don't want you to leave the misimpression that we're sort of breathlessly waiting that. I've called for a task force to revisit both the private and public data we use to make our decision making. That task force is out doing their work. I'll be checking back in with them the next couple of weeks, but I wouldn't say we overly relied on any one piece of data, including that data, which surprised some a couple of weeks ago.
Neil.
Hi, Chairman Warsh. Thanks. Neil Irwin with Axios. Thank you for taking our questions. So the Fed funds rate is now about 75 basis points below the 2-year yield. Suggests markets think you'll have to tighten eventually, about 100 basis points below most Taylor rule estimates. You're hitting your employment mandate, inflation stays high. Why should rates not be higher today?
There's a lot in there, Neil. So rates are higher today than they were 42 days ago. Markets have made decisions because we step back in part from trying to influence those. Market judgments have moved up on what nominal rates are across the Treasury curve. That doesn't mean we take them as by dictation, but we're observing them. So I think it's a mischaracterization to say that markets haven't reacted because we didn't move today. Markets are reacting in real time. In the period ahead, we've got important decisions to make about the policy rate. Markets in the intervening period, I think, have quite a bit of decisions to make. I'll see if I can put it this way. Monetary policy matters not just by what we say or even what we do. Monetary policy matters by how it affects the real economy. And these prices that we see in financial markets is one of the many ways in which it affects the real economy. We'll be continuing to watch that market information, see how it responds to incoming events, and that can help inform our decision making when we meet in 7 or 8 weeks.
How would you characterize in the family fight the last couple of days of you and the other 8 members who wanted to hold? Was that a strong conviction or was that a hair trigger close call on holding versus tightening? Well,
I think the vote was 9-3. The broader discussion to my ear over the course of the last days showed a lot of agreement on the hard questions. The 4 questions I raised at the outset about what's really happening in the economy with the shocks and absent the shocks. What are our tools and our capabilities? What's the effect on prices on output? I heard a lot of commonality on the questions. Were there different leans on the answers? You bet there was. So could people come to different conclusions? Absolutely. But my own judgment is this is a period of watchful thinking, not watchful waiting. And I think the score on that vote was unanimous.
Colby.
Thank you. Colby Smith with the New York Times. You've mentioned that looking at the Fed's policy tools is one element of a three-pronged strategy to address the inflation problem. So I'm curious how you view the effectiveness of those tools. If inflation is too high and not coming down, is the best remedy to raise interest rates?
So that was the discussion in the last 2 days. Is that the dominant remedy if inflation continues to be elevated through the forecast period? Interest rates could well be part of that solution, but I wouldn't say it's in isolation. I tried to describe in my remarks today a point that I made into the oversight committees a couple of weeks ago. I think there was a misimpression by some in financial markets, by some households and businesses, that central bankers like me, we set a 2% inflation target, but maybe we were more tolerable of a somewhat higher inflation target. In economics, we'd call that the revealed preference. And so might it have been rational for people to think, well, their inflation target's somewhat higher. What I heard in the last 2 days, what I've heard in 8.5 weeks is no. We will deliver the 2% inflation target. That is the committee's definition of price stability. So one way, absent the tools that you reference, to ensure that we get there is ensure that expectations are centered around the right number. And I think we've made some progress on that. I am not suggesting we're done on that. It's worth reiterating. And ultimately, the business we're in, Colby, is performance. We are going to be judged by how we perform. And that's what we intend to do. The inflation target, making clear expectations is one part of it. Making sure we demonstrate we're responsible for it, we're not blaming as another. And our policy tools, like you referenced, is the third and equally consequential part.
How are you factoring the fact that a large portion of the inflation overshoot is being caused by supply shocks, as it's mentioned again in the statement? Does that blunt the effectiveness of rate hikes in your view?
First, on the premise of your question, it was almost as if you were listening to our discussion in the last day and a half. A lot of our focus was on trying to understand and identify underlying inflation dynamics amid shocks. We take these shocks seriously. There have been a series of them that have been hitting this economy. We're not looking through them and saying, oh, they don't matter. But we're trying to understand is to what extent are these shocks broadening in their effect, broadening in their impact on prices that are quite far removed from it. Our goal is to have growth that is broadening and inflation that is becoming more limited, more circumscribed. I'll be the first to admit the shocks make this job and this policy conjuncture a little tougher, but that's among the chief questions we've asked ourselves. And around the room, people have different views on it. I tend to think in the coming months we're going to refine that view and have a better judgment, and we're going to have market prices trying to help inform it too.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. I guess I want to drill down maybe a little bit. What specifically, in your mind, would be the argument then for a pause today?
So I wouldn't characterize what we did as anything like a pause. I would characterize what we did as a rigorous review of the economic situation. I would characterize what we did as a review of the big, hard questions. And I'd characterize it as a view of what our own homework is to try to resolve those questions in the period ahead. If you were to try to force a description that this was a pause, I would say financial market prices would take the other side of that. Financial market prices in this intermeeting period, they didn't pause, they reacted to the inflation data in one direction, strong economic growth in the other direction. And nominal and real rates went up. Did the Fed take an explicit change in its policy rate today? No, but I think that's the beginning of the story, not the end of the story.
And if I could, I did want to ask, not forward guidance, but looking forward. Traditionally, a Federal Reserve chairman uses the Jackson Hole Summit as a sort of a reset of monetary policy. Well, how do you look at the speech that you're going to make in August?
I look at it like a blank piece of paper right now. I have not begun consideration with the incredible team here what would go into that document. I think you've characterized it correctly. Historically, at least from my first tour of duty at the Fed to more recent periods, it would be sort of a setting up speech more often than not of what was going to be happening in the fall. I haven't made any judgments on that, but those are judgments we'll have to come to. If I could, in the high mountain air in Jackson, Wyoming, I'd like to also frame the big questions. There is a tendency, especially with the proliferation of meetings and press conferences, to get caught up in the myopic. Did you do this by a quarter or do that? Ultimately, whether we deliver on price stability matters some, the decisions we make in 6 or 7 or 8 week periods. But they matter more, what are the big questions? What's really happening with productivity? What's really happening with demographics? What's really happening to the global economy amid the shocks? Haven't made a decision whether it's going to be a big picture speech or whether it's going to be a more traditional setup for all the action we're going to have between September and December. I will tell you one other thing that I am doing between now and Jackson Hole, so I'm checking with those task forces. My first principle of establishing a task force is find the best subject matter experts anywhere in the world and put them together, especially put them together with other people who might disagree with them. In the next couple weeks, I'm going to be doing a check back in. I've given them time to sort of think hard about their agenda, their debate, their schedule, and when they might be ready for prime time. I'll be doing a little bit of that checking, and that may or may not inform anything I have to say in Jackson.
Nick Timmeros of the Wall Street Journal. Chairman Warsh, I want to follow up on Colby's question about policy transmission. You've said there's no cruel choice between stable prices and full employment. Rates bring inflation down by cooling demand. It's generally thought that can show up in the labor market. If that's not the channel you're relying on, what is?
Yeah, so let me go back to first principles, Nick. I don't believe that either part of our mandate is generally at war with the other part. I do not believe that price stability and full employment is an either-or proposition. There have been policymakers over the last several generations who have thought that there is a strict trade-off there. That isn't my judgment. In fact, my judgment is if and when we deliver on our remit, we're going to be satisfying both prongs. We're going to have price stability and full employment. And in fact, if you want to do the most harm to the labor markets, you would run a period of high inflation that's variable such that employers, businesses, wouldn't really know what's going on. So I think the two parts of our mandate are equally important. We have no legislative orphans here. I've been talking mostly about price stability because we're doing pretty well collectively as a country, as policymakers on the full employment side. But we're doing considerably less well on prices. That's why we describe them as elevated, and that's what's taken most of our discussion. In terms of transmission mechanisms of monetary policy, I think different tools work through different transmission mechanisms. The interest rates work through lending channels and credit channels, maybe confidence channels and foreign exchange. The balance sheet probably works through some other channels like signaling and portfolio balance. We're keeping full abreast of all these tools and making policy. But if the suggestion is somehow we're going to be fine-tuning aggregate demand so it catches supply, that's not my mental model. I don't think we're great in the fine-tuning business. We're trying to get supply and demand in broad order. But really what we're doing as we sit here today at this press conference is I think we've got a reasonable sense of what aggregate demand looks like in this economy. We're inferring aggregate supply. We're making a judgment about what productivity is. And in some sense, there's a race between supply and demand. And the surge in business CapEx in around AI, it's making that calculation a little harder to judge. But in the period ahead, we're going to be trying to judge just that.
And if I could ask, where exactly was the disagreement today? Was it about the inflation forecast, or was it something more around the risks, the tactics?
Yeah, so I'll let the dissenters speak for themselves. The way I heard it over the last 2 days was overwhelming agreement
on objectives and authority and commitment. I didn't hear anybody walking away from it. The judgments as to how best to achieve the price stability, that was probably the question that we were trying to answer. What's the best move? What's the best strategy? What's the best way to achieve it? And a second question that was asked is, when do we need to make those harder calls? When do we need to make those decisions? And like I said to one of your colleagues, I was comforted that markets in the intermeeting period weren't reacting to us. They weren't reacting to dots or to speeches. They appeared more than ever to be reacting to real-time events. So they're gauging themselves how restrictive the Treasury curve should be. And that, I think, has been a useful development. We don't endorse any particular market move, but I'd also suggest we observe them with keen interest.
Janelle Martin with Bloomberg. Following up on that, there was more uncertainty in the markets about what the Fed would do at this meeting. To some extent, you might think that's what you want to see. But my question is about, is there a point at which you would not want to surprise the markets if they were pricing in something with higher certainty that was opposite of what you were intending to do? What are the risks that you see associated with that?
Yeah, so it's a good question. Surprise is not the objective function. Surprise is not what we're solving for. We have a clear North Star. What we're solving for is how to make the best decisions. Almost everything else should be in service to that goal. By not spoon-feeding markets, by not previewing our decisions, by not sort of giving nudges and leans, my colleagues and I have found in the intermeeting period, what we're getting is the views from a very accomplished economist. That's the internals of financial markets. Instead of just repeating or echoing what we're saying back to us, they're giving us somewhat, not perfect, their own judgment. Surprises are not the objective, but at the same time, I would say we didn't come into this meeting feeling constrained by the full range of alternatives we had in front of us.
So some of your peers have continued to discuss how they think about policy decisions, and if you don't offer your reaction function or your way of thinking about it, how concerned are you that you're ceding control of the narrative?
So I'm not very concerned. That's a short answer to the question. When some people that follow the Fed say, well, we don't want your forecast. We don't want your dot. We just want your reaction function. Part of me hears what we really want is your forecast, and what we really want is your dot. In terms of reaction function, let me sort of disabuse people of a question that may or may not be real and be out there. Any central banker, especially a central banker where the labor markets are more or less at equilibrium. Any central banker, when he or she sees underlying inflation moving higher, he or she is more inclined to tighten policy. Again, when you've achieved the other side of your mandate and you see underlying inflation falling, he's more inclined to loosen policy. That's my reaction function, and I don't suspect it will cause people to not continue to pry for more, because the truth is, for a very long time in a lot of countries, coming out of the 2008 crisis, we're in crisis mode. We were purposefully providing a lot of information, trying to provide a lot of assurance, trying to tell people exactly what we're going to do, offering forward guidance with clarity as if we're tying our own hands behind our back. Well, in crisis mode, that strikes me as a very prudent policy. But in more benign conditions, it strikes me as worth revisiting. But markets and market participants and reporters have learned to devour all that information, so I take seriously that the pullback of forward guidance requires some transition. Reform isn't easy, but our general judgment is going to help us make better decisions, and in so doing, satisfy our remit.
Thank you. When you talk about the 2% inflation target, what measure are you relying on?
Yeah, so I'll give two answers. First, let me give the proper standard answer. The Federal Reserve every January outlines a statement of purposes and strategy. And in that strategy document, which I believe was dated January of this year, it describes a measure of PCE inflation as the objective function there. I have enough of my own, so that's our number, we're sticking with it. Who knows come after next January what we might say about strategy. I suspect the task forces might have something to add. But I'll say this, some version of the Lucas critique, some version of Goodhart's law in economics should remind us that when we talk about measures of inflation or something else, and we describe those measures as being consistent with our objectives, we might make them such that they're not very good measures or very good objectives. Broadly, if you said to me standing in front of you, I abide fully by the strategy document, we're going to deliver 2% inflation and not a whisper more, but to achieve that, I'm looking at a broader set of inflation data than PCE. So without sort of fully revealing my cards, I'm trying to understand, like my colleagues, what's the underlying generalized change in prices that are happening in the economy. It is not a perfect science. I might have said 42 days ago, I've got a task force for that. But we have a data project that's trying to look and see whether we can't separate the noise from the signal. And so if you would hear a message from me, yes, I care about what the PCE prints are. I care about what the contributions are from CPI and everything else. But my lens is broader than that, even though the remit is quite narrow.
Michael McKee from Bloomberg Radio and Television. I'm struggling a little bit with some of what you've said today, and maybe you can help clarify this. You've said over and over again that your job is to bring down prices, to get prices stable, to hit your target, and that you will hit your target. The market says you're not there yet because they've raised rates, but all you've talked about today is talking about it. And it's not like members of the committee weren't there before you talking about it. So I guess what the American people might be asking is, what are you waiting for?
Yeah. So, believe it or not, this press conference is not all I've done today. We have spent an inordinate amount of time in the last 2 days, 2 weeks, looking at our monetary policy strategy, evaluating our tools, thinking hard about the sources of data that we have at our disposal and we wish we had. We've also thought hard about the period ahead. What among these questions will be answered with more clarity, certainly not certainty? So the decision we'd made today, the discussion we had in that room, was the farthest thing from inertia I can imagine. As a point estimate at this very moment, in a choice between two alternatives, you heard the results of it, but I would tell you that this discussion was far more robust, and our thinking about how best to achieve that target is advanced, and over the coming months I expect it to be advanced much more significantly. If you were to if I were to steal a follow-up question, I won't let you won't be giving it up. If I were to steal a follow-up question, well, what's the world think about what you've done? I would again reiterate, what we do isn't just about what we say. It's not just about what we do. We're in the performance business. And so if I look at the Treasury curve, if I look at the dollar, if I look at a lot of things that are internals inside of financial markets, I think what they're broadly saying is that this committee does own it, has the credibility to deliver it, and they believe, like I do, that we will. But I don't want to leave you with a misimpression. We've got no magic wand. This isn't something that we're going to be able to carry out in days or weeks. But we're going to deliver on the responsibility that Congress gave us. And today's meeting and the preparation for today's meeting
was an important step towards that destination. I'd like to follow up on the.
All right, guys, I'm going to come back on real quick for those of you still here. Wendy nailed it. He's very evasive. But I think if you read between the lines, he's just saying we're going to get inflation where we need it to be one way or the other, without hiking rates. So, in other words, the same thing he said last press conference, they're just changing the report. And I think we're going to see that with the next CPI data report, because inflation's not coming down, but the report was a massive record-breaking drop last time because the data being reported is not the same. Okay, that's just my opinion. We will find out. Guys, I know a few of you picked up the new indicators while we're on the stream. I got notifications. If you did, be sure you watch the videos that go with them. Each one is linked to the indicator right here. The Damien video right there, Bjorn, Alexander, Lionheart, whichever ones you guys got, be sure you watch them. They're kind of your how-to tutorial. And if you have any questions, jump in the Discord, ask me. We made the 3 pros, Max, John, and Brad. We made them moderators today, so ask them if you see them online. But be sure you don't just throw them on the chart and start trading blindly with them. I know I make it look easy, but I created them, so I understand them. So just make sure you understand them. If you have any questions, let us know. I'll be happy to answer. You will find massive success, in my opinion, with these 3 indicators, but just make sure you're on the right time frames, you have the right confirmations, and you're looking at the right thing, okay? And most importantly, you're using them in confluence and not independently. They're good independently. They're great in confluence. So get them. If you have questions, let me know, but watch the videos. I think I do a pretty good job of explaining it. And if you're trying to use Damien and Bjorn together, I did actually put out a video the other day. I did a live stream. I don't even know if I can find it. I don't even know where my channel is. I did a live stream the other day. In addition to these videos, the only 2 indicators you will need is a Q&A. So everybody had questions. We walk through them. Alexander is not featured on there, but that is Damien and Bjorn. It is in depth. So go watch that. Spend a few minutes. If you got the indicators and you want to be successful, this is called doing your homework, doing your research, getting prepared, right? Just get prepared and then go implement, even if it takes you just an hour out of your time so that you become a, an expert on them. And then the Alexander video I put out today. So let me know if you have any questions, guys. The Lord loves you guys. I love you guys. I will see you next time.